Despite persistent global geopolitical frictions, easing Middle East supply disruption risks have softened crude oil prices, realigning them back with the primary downtrends in place since 2022. Hello everyone, this is Razan Hilal, market analyst with Forex.com. Today is January 16, 2026. CME crude oil option data reflects a notable decline in volume and open interest on January 15th amid easing Middle East headlines. However, we still have an overall dominance for call option volume over that of puts, indicating ongoing upside hedging for crude oil amid an uncertain head start for 2026. So analyzing the Brent chart from a monthly time frame perspective, we can see an overall hold for the price action above the lows of 2025 and the 58 mark, which aligns with the golden 618 Fibonacci uh, retracement ratio of the overall bullish surge for crude oil prices between the lows of 2020 and the highs of 2022. So the overall hold over here is above the 58 mark, and the clean hold below this mark is expected to expose prices all the way down towards the 51 mark, which aligns with the lower boundary of the respected downtrending channel since December 2023. From a weekly time frame perspective, the overall hold for prices above the 618 Fibonacci retracement and the 58 support lifted prices back towards the 6630 mark, which aligns or which can be derived using the Fibonacci extension tool placed between the lows of April 2025, the highs of June 2025, and the lows of December 2025, aligning with a 0.382 Fibonacci retracement extension ratio. And the clean hold above this level is expected to extend bullish forecast up towards the upper boundary of that respected downtrending channel since 2023 at the zero point 0.5 Fibonacci extension near the 6880 mark, and the clean hold above that is expected to extend gains all the way towards the golden 618 near the 71 mark before confirming a longer-term bullish breakout for crude oil prices or another pullback within the borders of that downtrending channel. Now, from the downside, short-term support levels can be identified between the 6220 and the 5980 mark. Below these levels, we can be exposed to further or steeper bearish forecasts all the way down towards the lower border of that respected channel near the 51 mark, as derived also from the Fibonacci retracement ratios from the monthly time frame of the overall uptrend between 2020 and 2022. Now, with respect to WTI, also from a monthly time frame perspective, we can also see a price hold above the 0.618 Fibonacci retracement of the overall surge between 2020 and 2022, eliminating noise and the shadows. We can also see a clean hold above the 618, which is at the 55 mark, and the clean hold below this level is expected to expose losses or bearish forecast down towards the lower border of a respected downtrending channel since the highs of September 2023, aligning with the 49 mark for potential or for another potential bullish rebound. Now, dropping down to the weekly time frame, the overall hold above the 618 and the 55 mark also lifted prices beyond the bounds of a shorter term downtrending channel respected since June 2025, realigning with the 6240 level, and this level can also be derived using the Fibonacci extension tool placed between the lows of April 2025, the highs of June 2025 minus the shadows, and the lows of December 2025, where we can see an alignment for the latest high on crude prices with a 0.382 Fibonacci extension near the 6240 mark. Now, a clean hold above this level is expected to extend bullish forecasts up towards the 0.5 and the 0.618 Fibonacci extension ratios near the 6480 or the 65 mark to the 67 mark, which can either confirm a possible shift in the overall crude oil long-term trends, either a longer-term bullish breakout or another pullback in line with the overall dominance of the primary downtrends on crude oil since 2022.